Good morning, everybody. I think we've just reached 10 o'clock Central European time, so I think we should start this webinar. Can I, first of all, welcome you all to this sustainability and climate change related webinar on what does it mean for risk management in insurance and pensions. A very warm welcome to everybody who's joining us or has already joined us this morning. I'd like to give a particular thanks to those people who volunteered as part of the AAE's activities in this space. The aim of the webinar is to give you or to showcase some of the activities that the sustainability and climate related risks working group are undertaking, hoping to undertake, will be undertaking in the next few months and going forwards. I'd also like to welcome you if you're not currently a volunteer for the AAE, and if anything whets your interest during this morning's session, then do please get in contact with Frank Schiller or myself, and we'll endeavour to route your willingness to volunteer to the relevant individuals who are leading the different activities. We've got a great morning session. We're going to try and cover a variety of topics which sort of cover different aspects of the E, S, and G within what's colloquially called ESG activities. So there'll be some environmental focus, particularly around climate change and the sustainability aspects there. But we also want to look at the social side of things in terms of maybe intergenerational fairness, how that works in practice, and some governance activities. We've got a presentation looking at reputational risks and some of the angles that can arise there. My name's Malcolm Kemp. I'm the chair of the Actuarial Association of Europe's Risk Management Committee. Most of the rest of the speakers, in fact, all of the rest of the speakers are linked and very kindly volunteer for the AAE. I'd like to thank them in advance for all their activities that they do. And just a few housekeeping matters. Everybody should have been muted when you came into the meeting, but if that isn't the case, we'd encourage you to mute yourselves to ensure that there isn't some extraneous noise on the background. In terms of questions, please could you ask them via the chat function. We've got a relatively high number of participants signed up for this morning's webinar, so I will try and moderate and go through the different questions that you raise during the morning. Do please send them to myself, or you can send them to everyone so that I can see the questions. And it may be that if I want further elaboration, then I'll ask you to say the same questions orally to the whole group. But let's see how it works with the chat function. So without further ado, I'd like to hand over to Frank Schiller, who is the chair of our AAE Sustainability and Climate Related Risks Working Group, who's going to talk about a paper that we've put together, agreed with the AAE board, which gives a high-level viewpoint on the AAE's position on sustainability. Over to you, Frank.
So thank you, Malcolm, for the introduction and for giving me the opportunity to present here. It's a pleasure for me to actually kind of set the stage for the rest of the webinar and tell you about the position of the AAE with respect to sustainability and climate change. So that was something we prepared as one of the first steps in the sustainability and climate-related risks working group I'm leading, and I think it's really a very relevant part of our work, just to set the stage and set the framework where we are working on. So what's actually the position and the concern actually we have at the AAE? Why is it so important for us to be active in this area? Well, we are really concerned about the effects we have seen in the past few decades already, and what we also anticipate that might come. That's especially driven by, well, we had all our experiences personally. We had our experiences, I think, also in the companies we're working for, in insurance and reinsurance, or in consultancy. We have seen in the last few decades that the number of events, natural catastrophes have increased. The losses have been increasing as well, and it will go on. So that's at least what the IPCC and their assessment report, the latest assessment report, states, that with the ongoing amount of gas emissions, the greenhouse gases will really lead to further climate changes, and that's something that has to be stopped. So it's scientifically clear that this is directly caused by human, and that was also the reason why we had the Paris Agreement 2015. We just had recently in Glasgow the COP26, where this has been confirmed that we want to really achieve this 1.5 degree warming target. Everything above the 2 degrees will lead to tipping points, and that's then even more dramatic and more drastic for well, us all, for the economy, and also for nature. And that's the reason why also we as actuaries see that we have to do something, that we have to participate in really fighting against this climate crisis. And we thought, what are the main topics where we can really participate, where we can have an effect and support these endeavors of well, reducing the effects for the economy, for society, and also take our part. And in the end, for us, it's 3 areas we can take, and then also position ourselves as the AAE, as the actuaries of Europe, to support this endeavor of well, reducing the effects, or even support the transition of the carbon, the situation of reducing the carbon emissions. The first topic is we ourselves, we have to manage the insurance and pension systems effectively, with short and long-term policy effects that might really come and affect us. And that's something we can directly have to do. And we have, actually, it's our task as actuaries to really be part of this, what we call social and financial sustainability, that we have really an effect, and then also take these transitions seriously and also contribute. The main way how to contribute, that's the second point, we can have direct effect on the climate sustainability, either as investors for, say, transition projects, or for investments that support the green transition. So that's the first part. The second part of climate sustainability is that, obviously, also, especially in non-life insurance, we will have to pay out on climate-related physical risks, and we have to do that also in the future to really support the mitigation of the future climate-related risks. And then the third topic, which might become even more important and more relevant, is an increasing protection gap, as the insurance risks might become huger and more difficult to manage. Also, the protection gap of natural catastrophes might increase, and that's also something we as actuaries might support to solve this issue. I'd like to come in the next few slides on these 3 questions and give you a bit more details on the respective actions. So let's start first with the topic on social and financial sustainability. And the first topic I want to stress here is coming under the headline of same risk, same capital. What I don't mean is that, for instance, as, for instance, stock or equity is the same risk, then they should always have the same capital. It's not what I'm saying, but what I'm saying is that we are quite clear that certain risks and certain types of investments, certain types of underwriting, even if it has the same group currently, it might have already include different risks depending on the exposure it has to the climate. And this is what we think of when we speak of green supporting or brown penalizing factors. These factors and this assessment, this risk assessment, also the underwriting risk assessment, needs to be based really on science and needs to be really reflected accordingly in the risk assessments. And not by only looking backwards, but also by including forward-looking considerations, which is very important, especially for climate-related risk, because many of these risks might just emerge over time, and we might not yet have them fully explored and experienced in the past. So it's very important to really base these assessments and perhaps also reclassify these risks according to what is green supporting, what is less exposed to climate change, and then also what is more relevant, more difficult, and more well, dangerous to insure and also to invest in. So that's when we speak of same risk, same capital, we actually mean that very reflected and science-based approach of understanding both risks on the investment and underwriting side. The second topic on social and financial sustainability is obviously then also an improvement of our own risk management framework, which is Solvency II. That we do fully support the current way forward as proposed from EIOPA, that first the climate scenarios of the ORSA are currently under review or well are implemented. So this year we expect in the ORSA that climate scenarios will be introduced. There have been some guidance from EIOPA. Just recently there's a consultation going on where we supported the way forward, and also we will give feedback on that. The second topic in that direction is also the regular review as proposed from EIOPA and then also agreed from the European Commission of the standard formula with respect to NatCat scenarios. Obviously, with the climate change, risks might change, and that needs to be reflected in the scenarios of the standard formula. Secondly, that's also very important. It's not just our risk management, but it's also the interface to our customers. And there we need to support transparent classification and then also an informative sales process to really inform our customers what kind of products they're buying and how these products support these ESG criteria, that also our customers can really have a full informed decision on what kind of products to buy and what kind of products not to buy, what products do support the targets of the transition, and on what products perhaps don't do that yet. Obviously, especially looking in on the social aspects of the ESG criteria, we believe that especially life and health insurance and pensions still have a very important part in protecting against losses or ability of work, and then also finance medical treatments. And that's really and will stay one of the main pillars of the component of the S component of the ESG. And that's also something we should still further in our analysis and product developments to really keep that in mind, that especially when it comes to the S, it's important to follow these aspects of having these social aspects also in consideration. The second topic is where we can directly have part in or participate in the or to support the transition itself. That's what we called as what we named climate sustainability, that we directly play a relevant role in this transition. The first part is really in financing the transition. It is important that, especially when it comes to life insurance, but then also to some part, for instance, for health insurance or for non-life insurance, it's not so easy to directly switch and completely change our investment strategies to become fully, in that sense, green, as we have kind of long-term investment strategies, and they cannot be quite easily switched by an instant. So that's something that's important also to understand by the politics. And again, there we will support and consult how this can be achieved, nevertheless, in a most optimal way. Secondly, it's also clear that when you just look on the effect of green supporting or brown penalizing factors on Solvency II, it might not play a very major effect. It might only play a secondary effect. Again, that's something we can consult and support how this can be implemented in an optimal way. But what is clear, all of these investments eventually also, especially these brown type of investments, there is this risk of these investments becoming stranded assets. When there is not sufficient deep markets, we need to make sure that these assets don't remain in our investment strategies, and we need to anticipate those asset transition risks quite early on, that we can really avoid to have additional transition risks as insurance and pensions companies. So that's also part for us, more this part of consultation of the politicians, but then also of our own asset and investment management. But then secondly, again, we will play an important role in financing the transition, especially by buying green bonds, supporting really the investment in these structured bonds for debts or loans for transition projects. I think we believe that this is one of the major parts we can play as investors, as financial institutions in Europe, to really support that directly. And for that, it is very helpful to have the European Commission to support standards for setting up green bonds, and then also providing, for instance, guarantees or structures that these kind of bonds are really accessible also to small and mid-sized insurance companies, that we can really have a broad effect on the whole industry, that we can directly support these transitions. Last but not least, it is the non-life insurance companies who will protect companies and also individuals against physical losses and provide the respective supporting services. It is clear that also these insurance companies, non-life insurance companies, need to include ESG criteria when they assess their underwriting and when they assess the risk appetite. So it will go hand in hand to have a support, but then also a focused support on what kind of solutions can be developed, and what kind of covers can be provided by these companies. But still, it is important that non-life insurance companies will play a very important part in mitigating also these risks that we will face in the future. However, some of these risks might perhaps really drop off the list of being insurable as they increase, and perhaps not enough capital is available to support and cover all these risks. And this might mean that, and this is already addressed by EIOPA, this might mean that especially protection gaps might increase over time as the risks develop and increase over time. And for that, it is not that the actuaries won't find solutions. It's really important that, especially in these cases, we need to make sure that we find other ways of ensuring public and undertakings to really be still able to mitigate these risks. And for that, however, it might not be possible alone for insurance industry to cover all these risks, but then we need to find solutions together with the government and find public policy encouragements, for instance, and especially facilities, protection facilities, to have possibilities to share these covers between public and private investors. Again, in that sense, it's important to work very closely together and find solutions that are going to work and mitigate these expected climate change risks we already foresee. In the end, it's not only a problem for Europe, obviously, and then it's not just the European actuaries that can solve who can solve these problems, but still, it is important that we take this step and that we, at least at this stage, can find solutions, can consult, and can support the transparency, and then also good and best practices how to tackle and mitigate these issues. And in the end, what we can at least support is, again, by providing transparency, to avoid any loopholes that, at least as we have found solutions in Europe, we might be able and should be able to really support these and promote these solutions we have in Europe, and make transparent if other jurisdictions, for instance, don't support and don't follow these good practices, and make this transparent by adequate accounting and valuation approaches, to really also support, again, investors and the public and the companies to find the right way forward, to have really always the transition into a climate supporting environment as a focus target for all of us. So that's the position of the AAE. I think it's a lot to do, and in the rest of today's session, we will kind of focus on 3 more topics where we already did some work, or we want to invest some further time, because we see we can have an special effect in these areas. But perhaps before we come to that, do you have any comments or questions you want to discuss with me and with Malcolm?
Yes, as I mentioned at the beginning, do please route your comments or questions through the chat. I know it's been a good discussion on the things that lead to climate change, not just being about emitting lots of CO2 or methane. There's lots of other aspects, biodiversity, reforestation, afforestation, etc. So good to get that engagement, and we'll obviously take those comments on board. There was one particular question that's already been raised by Paulius. It's a little bit more technical and is related to the latest regulation amendments, where the actuarial function is expected to assess quite a lot of different risks, including sustainability risks. And Paulius was just wondering if there was any perspective we could offer, or you could offer, on how deep the assessment that the actuarial function should cover. If you think that's better for the panel discussion, we can carry that forward, Frank, to the panel discussion, but maybe you've got some immediate thoughts yourself.
Yeah, perhaps just coming to the role of the actual function, I think it's important to see that most of the time the actual function does rather, I would say, not have the full-fledged assessment, but the actual function should facilitate that these risk management actions and also the assessments should take place in the company, and that all these experts who are relevant to make these assessments do these assessments and provide this assessment to the actual function. So I think it's more organizational topic that needs to be done by the actual function, then also in the end a controlling function and controlling function, that it really takes place and is adequate, because otherwise it wouldn't be possible for this function and its team and his team or her team to really do this so comprehensive and so complex assessment. But I think with that, saying that, I think that's very a very good question. We should then perhaps in more detail discuss, as you proposed, Malcolm, in the panel discussion, because it is really one of the big questions, how to tackle these complex questions with the small teams we have typically in our second line organizations within the companies, because typically we cannot do that in these small teams without all these experts that are needed to assess these risks. We need to organize ourselves and also rely to the experts in business to really assess these risks adequately.
Thank you. Another question that's come through to me is, I think, more procedural. Do you plan to assess the risk of green asset bubbles in the activities of the sustainability and climate related working group?
I think most of us are already aware that these kind of bubbles could evolve over time. The question is, how can we assess it quantitatively? And that's really difficult. And the problem is the same as for, say, any other bubbles, housing bubbles we had, or other bubbles we observe in other countries. The question is there a bubble? How quick is it evolving? When will it burst? So we really have these issues of really quantifying these kind of developments. But still, I think all of us are really aware of that there is this risk of such a bubble, and then we will need to manage that. But as I say, so it's assessing quantitatively these kind of bubbles is always quite difficult, and we have had these difficulties also with other bubbles in the history.
Fair point. And a final question would be, suppose I'm an actuary and interested or concerned about climate change. What would you recommend I most focus on? And here you could mention the AAE's activities, but is there anything else that you feel that we should focus on as individual actuaries?
I think it really depends on your current role in the company, and in each position you might have, starting from product development to like pricing functions, quantitative functions, valuation, risk management. I think in the last few slides, in each of these roles, there are certain topics you could address, especially relevant for your function. So for instance, starting with product development, you could always think of what kind of products are then really optimally supporting the transition for life, for health, but also for non-life. So how could you structure and adjust the products you're developing that they become even more sustainable, even more supportive for the climate change and for the transition? In valuation, how can you support making these effects more transparent, support your management in understanding and assessing the risks more easily? The same is true for risk management. So I think it's depending on the role, you can always have a very important part in supporting your company in doing the right thing, driving informed decisions and producing the right products for supporting these climate change targets. And I think we will have, as we are the ones connecting the dots, I would say, bringing things together and transforming them into quantitative analysis, and then also informing our management and supporting the production of the right products. We are the ones really with the steering wheel in insurance to really drive things forward. So if that's helpful.
Yeah, brilliant. Thank you very much. Right, I think it's time for us to move on. We've just had Frank explain the merits of engaging in climate change and how we can all help. Of course, some organizations find that the focus is sometimes on how they might have hindered climate change. And what we've got now is a presentation from Jerome Krugnola Humbert and Thomas Cree, which on the impact of on reputational risks of insurance and pension companies as a result of sustainability issues. So focusing on the reputational side, the reputational damage that not focusing on some of these issues can generate for companies. So Thomas and Jerome, over to you.
Thanks, Malcolm, and good morning, everyone. Can you just confirm the presentation's on screen because I'm in presenter mode and I don't see it?
It is.
Great, fantastic. Very happy to be here with you today. And so together with Tomasz Krylovich, we are going to talk in the next half hour about a forthcoming paper, that AAE paper that we've been writing on sustainability and how it is linked to reputation risk for insurance companies, pension funds, and financial institutions. Just a bit of context to start with. The idea here was to combine existing AAE work streams on sustainability and climate on the one hand, and on reputation risk and conduct risk on the other hand. And in the writing team, besides Tomasz and myself, there's Clara Armenko-Vivas, Jana Zelinkova, and our sustainability chair, Frank Schiller. The paper's not finished yet, but we're quite advanced, and it will be finalized in the next couple of months before the next AAE spring meeting. So in addition to classical financial statements and financial metrics, so-called non-financial factors like sustainability and ESG, environmental, social, and governance issues are increasingly used by investors and other stakeholders in assessing risks and opportunities. And as a matter of fact, we're certainly moving in the next few years towards some integrated reporting where classical financial metrics will be complemented by climate and other sustainability disclosures and other non-financial information. Specifically today, that's what we want to give a first overview about is how sustainability and ESG issues can impact a company's reputation. So the aim of our forthcoming paper and of this short presentation is to describe these risks and highlight the main challenges, and ideally to support actuaries and risk managers in the identification, assessment, and mitigation of such risks, or at least give some first ideas. For example, we think it could be used as some first input to the ORSA and ORA processes. The structure of the paper, which is also going to be our presentation today, is first how companies are impacted and affected by such reputational risks through media channels, for example. Then Tomasz will talk about green products, greenwashing, and also giving some examples. And then I'll be back to conclude with probably a lesser known aspect of this, which is how a growing protection gap, for example, for climate, fuels reputational issues for the insurance sector as well. As most of you are certainly aware of, there's really an increased attention, scrutiny, and pressure from civil societies and from NGOs, non-government organizations, to integrate sustainability and climate considerations in the business and investment strategies, not just of industrial firms or big oil or governments, but also of financial institutions, banks, insurance companies, and pension funds. That's, on the one hand, that's great. That's really a potential driver for triggering positive change. But on the other hand, companies have to be aware that it also creates an increasing reputational risk for them, especially if they're not really either not doing anything or not really practicing what they claim to be doing. That's greenwashing, and we'll come back to that. So they could be victims of name and shame tactics. Just to briefly quote a striking example that happened a few years ago here in my hometown of Zurich. You may have heard of Credit Suisse, which is one of the largest Swiss banks. So in 2017, activists from Greenpeace rappelled down from the roof of the building where Credit Suisse was holding their annual shareholder meeting, and they deployed banners that you can see in the picture here, highlighting both for investors and for the wider public that the bank was financing some controversial pipeline projects and fossil fuel developments. So obviously, that's not something any financial institution is keen to be put in the spotlight for. And nowadays, social media spreads negative news very quickly. So we believe that monitoring NGO reports and media coverage in general can provide some interesting early risk signals for insurance companies and other financial institutions and for their risk managers to identify reputational issues. Because NGOs like, for example, Greenpeace, WWF, Reclaim Finance, and others nowadays are really hiring experienced finance professionals and putting out, for the most part, excellent and well-researched reports about greenwashing and what the insurance industry, what pension funds and banks are actually financing or not. Just to quote another example, there's an NGO called Insure Our Future, who produces every year a scorecard for the insurance industry. You can see here on screen an excerpt of their 2021 report, where they rate insurance companies and reinsurers on what they actually do in terms of insuring fossil fuels, that's the underwriting side, and supporting them with investments or divesting, that's the asset side. And also highlighting any discrepancy there is between the public discourse and public pledges of such companies and what they actually do or keep doing in terms of business as usual here. So we believe that's those reports that most actuaries may not be familiar with are actually things that have to be integrated in, let's say, the overview and risk management for sustainability reputational issues. And of course, one of the greatest reputational issues is greenwashing, which Tomasz is going to talk about now. Tomasz, the floor is yours.
Yes, thank you very much, Jerome. Thank you much for it. Exactly as Jerome has highlighted, there are many elements and aspects which companies might be hit from the reputational point of view, and how the companies may react to this. This is what I would like to talk shortly. What are the main risks which might be hit to the company, reputational risks? We think there are three main areas which we may look at. First, refer to the market valuation of the assets. And here, of course, the first aspect would be the shareholder value of our company, insurance company, of the given or pension company. Any our actions which we will be doing, as it was presented, for example, with the bank by Jerome, we could see is impacting our shareholder value and our company. The same, however, refers also to the value which we are creating and giving to the client in our investment products. If we are offering them possibility to invest into the green, or we are not offering them to invest into the green. It was already mentioned about the investment bubbles. Exactly, if our old products are not offering any gain and sustainability premium to to our clients, we may potentially see some reputational issue materializing in business lapsing from our old portfolio. However, on the other side, if we are investing and promoting intensively our new products, which are focusing on the green products with sustainable premium, we may put clients into and direct clients into investment bubbles and might be accused about mis-selling. So another element which is putting us on the reputational risk. So these two elements which we wanted to spot. If we have the product and if we want to, and we are aware about how to, we want to address the ESG issues in our product, even then we might have meet the two risks. First, if the reputational risk. First is that what moving ESG target, what currently might be seen as the ESG optimal and addressing the ESG issues in the good and sufficient way, it may be not be seen by all the participants in the market, or soon may not be seen as such. And in other words, in uncertainty regarding what exactly is the green product, what exactly is the ESG, and how it is being perceived might be generating itself the reputational risks. We might be company might be acting in the good faith, however, might be perceived by the customers, by the NGOs, by the media, not exactly like this. From this point of view, any legal standards or any standards in the market could be mitigating this uncertainty, and through this mitigating the reputational risk, referring and regarding this moving target and this what definition about ESG standards. EU taxonomy and SFDR are the examples which might be helping us to limit this uncertainty and this reputational risk here. And finally, if we have the product, this what might often be accused is the greenwashing, meaning that the product is seen to be have a green behavior, but in fact is not the one. So we are selling something as green, but it is not green per se, and it is not exactly green. The term itself, which might be giving a little bit, before I go into some details, might be giving some idea about what greenwashing might be, was coined in the middle of the 80s by Jay Westerfeld, the environmentalist from New York, who noticed that hotels were promoting the green behavior, save the environment, by convincing clients to reuse the towels. However, in fact, this practice was mainly saving the money for the companies, and not that much was transferring into the real, for example, limitation of energy waste or any profits for the environment. And that's why this term has been coined and is also presenting how the greenwashing might be perceived and what might be mean by greenwashing. But how we in our company may define and spot greenwashing examples. If we go to the next slide, we may see the examples which were, or some ways to defining the greenwashing, which was prepared by TerraChoice, which is the underwriters laboratories, currently part of the company, who is proposing the so-called 7 sins of the greenwashing. So first of all, sin of hidden trade-offs, meaning that we might have the situation that we are focusing on something which is really green, but there is an element additional in the product which is not exactly the green. For example, a paper might be produced from the forests which are done in the sustainable way, but there are also some chemical processing which is absolutely producing the green gases, for example. Sin of no proof, that we are claiming that there is something green and the product is based on green. However, in effect, we are not providing any evidence, any real tangible, which client, customer, NGO may find there in the product. Sin of vague language, meaning that, okay, we are saying that we're using general words, very poorly defined statements, which are to create an impression that something is green, but not necessarily being like that. For example, saying natural or all natural might be such an example, but arsenic, mercury, for example, can also occur in nature and may come from the natural sources. So will not necessarily be treated as exactly being the green. Sin of false labels is when we are trying to contact our product with the situation and giving an impression by words or visualizations, pictures, that there is a third party, some certification party, who is signing and giving us the label that we are a green product. However, when in reality, nothing like this exists. So this is a fake label. Sin of irrelevance, which is probably for the quantitative perspective, the easy to understand, is when we are mentioning about, or maybe mentioning that something is, an element is green, which is really there, but it is covering, it will be covered, for example, anyway, or is not relevant for all the situation. For example, the refrigerators are currently being need to fulfill some standards, referring, for example, to the Montreal Protocol from the middle of 90s. So, but this is everybody, all the refrigerators are doing something like this and are compliant with this law. So claiming that we are green because we are compliant to this regulation is irrelevant comparing to other products. Sin of lesser of two evils. This is when we may look on the situation where we are putting on something really a true claim, where we are putting some focus on some element of the product. However, the whole product as a whole is not necessarily and cannot be, or very difficult to make be green. Such examples given are, for example, organic cigarettes or fuel efficient sport utility cars. So something which is in general as whole not exactly green, but this is some element is just green. And finally, sin of fibbing. So in other words, that we are claiming something which is totally not true, and we are just cheating and making not true, not true statement. So these are the examples which may help us with the products to creation of the products as actuaries, risk manager, to avoid any elements which may even unintentionally lead us to the issue with the with being accused about greenwashing. What examples we may find in the reality about different behaviors which might be accused about not being green and controversial from the reputational point of view? Two examples from outside of the financial industry. One is Siemens, who as whole was claiming and acting in with a strategy to be green. However, came into 2 years ago into the contract with the controversial Australian coal mine, which was the matter of building the fracht terminal and connection, the maritime fracht terminal. Because of the negative press was there and NGOs attacking Siemens, Siemens has confirmed the contract, and this caused a really negative press coverage to the company. So strong that the stock price initially fell by 10% in a month. And it was happening just end of 19 and beginning of 2020. Another is the Volkswagen emission scandal, which was an example of making a false statement and unintentional actions with the programmed motor engines, which were making a false testing results, while in reality, in the daily use, the cars were producing high and were not meeting the requirements. Except of the bad press, there were also big aftermath drop in the equity and fines accused to the paid by the company, and also the CEO was pleaded guilty to criminal charges. So there were consequences also for the executives. And last two examples. First, if we may go, yes, and first would be from the financial institutions, which is referring to the DWS, which is a investment branch of the Deutsche Bank. They were offering the products and which were supposed to be green, and those products, however, were accused by the former head of sustainability division in DWS that in fact after 6 months she left DWS, she has claimed that in fact DWS was exaggerating the statements about the greenness and sustainability of the investment of the products provided. That in fact the company was mainly investing in the titles like Microsoft or Apple, and not exactly focusing on these products, on this area which were to be green. So from this point of view, it was total exaggeration. As a consequence, there was an investigation of the BaFin, the German Federal Financial Authority, into the company. The stock prices has fallen, but by almost 14% in one day. And of course, the confidence in this type of instrument and products was lost. And last example is referring to the British Petroleum, which 20 years ago already decided to move and to show the approach to the green products. They wanted to go and to focus on the green area of the energy, and it was recalling itself as Beyond Petroleum. However, in the next years, the actions done by the BP were not following it, so there was a bad press there. Although there were no big changes in the assets and prices, however, the company itself finally changed the name and reverted from the Beyond Petroleum. So these are the examples. Thank you, Jerome.
Thanks, Tomasz. So to conclude this presentation, I wanted to highlight another very distinct area which may not be so obvious. It's how issues around insurability, affordability, and claim service, and well, the protection gap, can also impact the reputation of individual companies and also of the sector as a whole. So I would say that the implicit expectation of governments, businesses, policyholders is that in the future, insurance will remain available, affordable, and that in case of adverse events, claims will be paid in full and on time. That would be the general expectation. However, the ongoing COVID-19 pandemic has reminded us that this is not always the case. So to protect their citizens and healthcare systems, governments around the world have ordered shutdowns of businesses, which led to significant economic losses. And a number of businesses thought they were covered by the insurance company under business interruption insurance policies, but later found out that they were only covered against damage business interruption, and pandemic shutdowns were considered non-damage business interruptions. So even though this may have been completely correct in terms of contractual terms and legal perspectives, this is still reflected very poorly on some companies and on the sector as a whole. And we believe that environmental and especially climate risk poses a similar threat, especially since the starting situation, which is not always well known, is that, for example, in the European Union, only a third of NatCats, natural catastrophes, are insured. So that's a study that IOPA did last year. Of course, there are variations by peril, by country, but overall, there's a protection gap of 2/3. And also, with climate change, we have perfect storm brewing with, so to speak, on the one hand, an increased frequency and severity of claims for some perils, and on the other hand, a concentration of insurance exposure along in vulnerable areas, such as coasts or big cities along rivers, etc. Oops, sorry. And one of the underlying problems here is the fact that most property covers are annual, renewed every year, with the possibility for insurance companies to reprice or drop covers or change conditions. So traditionally, this used to reflect, and this is still valid in a number of areas, a balance of interests between insurers and their customers. The idea is that, as I said, insurance companies can adjust when more is known about the risk or the risk changes. They can adjust their price, whether they cover or not the deductibles, etc. But on the other hand, customers can also walk away every year and change insurance providers if they find a better deal, lower premiums or better conditions. However, with climate change and for some perils, this is completely imbalanced now in favor of insurers. A striking example would be some US states where it's near impossible or unaffordable to find insurance cover against floods or wildfires. And as this is growing and as insurance companies, again, it's a very sound decision on a microeconomic perspective for them to say, I don't want to cover this risk anymore, but as the whole insurance industry is doing something similar, this is really leading to a political and regulatory backlash. So in the context of COVID-19, for example, in France, there were threats from the government to impose higher taxes for insurers. So in the end, this was resolved by insurers voluntarily, so to speak, agreeing to have lower premiums for business coverages. In California, that's also quite interesting. The insurance commissioner for some zip codes has imposed a moratorium on non-renewal. So if you're an insurance company there in certain areas, you are not allowed to not renew wildfire covers for your customers. So what's the potential way forward here? We believe there's really some interest in exploring what IOP has called impact underwriting. So insurance mechanism whereby there's a financial incentive for customers to mitigate the risks. Smart claims payments, also known as Build Back Better or Green for Old, are also another interesting avenue to explore. For example, instead of an insurer having to pay every year damages for a house in a vulnerable area that's going to be flooded over and over again, they could pay a bit more for the policyholders to flood-proof their walls or move to another area. But again, this is hitting the short-term issue of annual property covers for such smart claims payments to be implemented. In conclusion, so very quickly to wrap it up, we believe that the convergence of media evolution and more focus on sustainability really increases reputational risks for the financial sector and for insurance companies. Greenwashing is a major issue in particular and is increasingly monitored by regulators and by the public at large, by civil society. Protection gaps, as I said, are another maybe lesser known aspect of this, but important to monitor. And also, right at the moment, if you look at the financial sector, banks, insurance companies, pension funds are making grand long-term commitments. We will have net zero underwriting by 2050 or net zero investing, but actually most of them take limited immediate action. So we ask how long can this discrepancy between long-term green commitments and short-term, mostly business as usual, how long can it last? And of course, reputational risk can lead to very concrete legal and litigation risk, whether it's regulatory sanctions, class actions from customers, etc. So we believe all of the above that may seem a bit fuzzy or qualitative should actually be high on the priority list of companies, risk managers, and actuaries, and that it should be monitored. Thanks a lot. I think there's still a few minutes left for Q&A. So Malcolm, I don't know if some interesting questions came up through the chat, maybe.
Yes, thank you very much. Can I again encourage you to come up with questions through the chat? I just wanted to highlight one first off, which struck me. You've got this slide that shows how companies are impacted by reputational risks and the scorecard produced by Insure Our Future. And I noticed that the highest score was 5.4 out of 10 listed there, and the lowest was 1.1 out of 10, which seemed pretty low. Is this an example? Do you think that's a kind of realistic view of how insurers are actually seen? And if so, is this an example of this broader reputational challenge that insurers have, and not just maybe perhaps just linked to climate change, but a wider dissatisfaction with the insurance industry?
That's a really interesting point. If I may quickly comment, I think this is linked to what we mentioned last in the conclusion, meaning the financial sector or insurance companies are actually moving towards more green, so to speak, but they're also doing a lot of business as usual and keep financing and insuring the world as it is, meaning with a lot of brown as well. And I believe, for having looked at a number of such scorecards and NGO reports, that's really the problem. Even the best grades are not that great because there's a bit more green, but still a lot of brown. And it's a difficult decision for a bank or an insurance company or pension fund to just stop completely investing in or fossil fuel companies or carbon intensive sectors. And I think this reflects that. More green, but still a lot of brown that coexist.
Yeah, thank you. And then in the chat, Sam has asked the question on the topic of annual property cover being imbalanced or unbalanced. Is there anything that the AAE or EOPA could do to step in to correct quotes the market failure that's involved in that imbalance.
Tomasz, do you want to answer or should I go?
Here we go.
That's again a really tough dilemma, because at the heart of 1-year annual property covers is this, in theory, balanced interests of customers and and sellers of insurance. So again, what the California example is interesting, because if nothing's done, at some point, I'm absolutely certain there will be regulatory intervention to de facto make some contracts longer than 1 year. But it's difficult to attack the principle that this is a balanced reflection of the interests of buyers and sellers of insurance. And it still is in many areas, but in climate, regarding floods and wildfires, I'm skeptical that it's still true.
I suppose what you're highlighting is that there is this protection gap, and it's not been so obvious or maybe so evident, but if the insurance market or insurance companies in aggregate aren't prepared to extend longer term cover, then some action is required at a more public level. Yeah,
exactly. So that again, my decisions from individual companies that are perfectly right in terms of risk management and microeconomics, when aggregated at society's level, lead to financial stability and macro protection gaps that will need to be addressed, if not by the insurance industry or the financial sector, then by regulators and governments at some point.
Maybe a comment just from my side is that for sure, because this is the question about AAA or EIOPA step in to correct this market failure, for definitely to give the more actuarial view, because sometimes this might be the market, either the decision makers in the market or regulator may want to step in to assure that everybody could be insurable. So from this point of view, AAA and EIOPA, especially AAA, could give more actuarial and risk-based view on this. And this might be the biggest, I think, the role which we would have to correct, and because the regulators, politicians may want to easily offer something to the client. So this would be the biggest, to give the proper scientific view.
Mm-hmm. I noticed that Sam's put another comment into the chat. Clearly, this is a topic that we should pursue further, and maybe Sam, we can contact you and get your input and feedback in that process. Right, I think we should probably move on now to the panel discussion. This is the panel discussion's title is Aspects of Sustainability and Climate Change in Insurance and Pensions. And so the aim is that we'll have a couple of relatively brief presentations, and then we'll move on to a broader debate amongst the panelists, and taking your input from the floor. Do please come up with your comments, ideally through the chat. As I said, if there's further input that would be helpful, I'll try and bring you into the meeting directly. But in the first instance, maybe we can hear, I think it's Frank, you're going to give the next short presentation looking at the EIOPA's consultation on climate scenarios, I think. Is that the case?
Yes, it is. And actually, Daphne will take the start, just to set the stage for the discussion.
Yes, thank you for the very inspiring presentations. I'm happy to be here with you to give you the context about EIOPA developments in climate change scenarios in ORSA. So EIOPA started last year with a consultation on what they would expect in terms of climate change risk scenarios in ORSA. And they started this consultation because they noted that approximately 10% of undertakings only would consider climate scenarios in their ORSA, whereas it is a significant risk. The final version of this document was published in April last year. And I really recommend you to have a look at the Appendix 2 of this document, because you have a nice mapping of the transition and physical risks with our traditional risks in the Solvency II standard formula. And we will elaborate more on EIOPA's expectations, but sorry, please remember that there are 4 clear expectations: that undertakings should assess climate change risk, should perform a materiality assessment, include at least 2 long-term scenarios, and there is an allowance for flexibility, both in terms of horizon and qualitative assessment. And recently, as Frank mentioned already, a consultation paper has been issued by EIOPA to make those expectations that will be monitored as from 2023 more, I would say, clear. And this is why we have this application guidance that is open until mid-February, on which AAE is commenting. And the target audience for this consultation paper was the small and medium enterprises, but it's really interesting for all of us. And you can really find a lot of inspiration there, and try to somehow make this concrete for your own situation. Of course, you really need to have a balance between guidance and still have its own as part of the ORSA. And we can really see this challenge in this consultation paper. You should know that next to this consultation paper, EIOPA intends to organize live and non-live workshops that will start in April. And the purpose is to have a final report by the end of June. So as already mentioned, there are also other initiatives taken by EIOPA. So we have the insurance protection gap, the impact on the writing, so how to design products to allow for some adaptation and mitigation to climate change, and also the fact that the cat-nat risk in the standard formula should be more forward-looking and reviewed more frequently. So I think on the next slide, you see what are the expectations of EIOPA. Well, first of all, you have to identify material climate change risk exposures. And what is meant by material? Well, in the ORSA context, it's really the people validating the exercise, which is the administrative management and supervisory body. So something is material if it would influence their judgment or their decision. Then, of course, in terms of horizon, you have the tragedy of the horizon, in the sense that there is a significant discrepancy between the concept of horizon for climate change versus the business context, because short term is 5 to 10 years, midterm next to 30 years, and long term above 80 years for the climate change. Whereas what we see usually is that short term is 5 years. This is your business plan horizon. Midterm is between 5 and 10 years to assess the viability of your new products, and above 10 years is perceived as long term. Of course, this horizon remains a guidance, and you have to somehow tailor it to your own business situation, but it remains a challenge to make projections in the long run. So, of course, you need to consider physical and transitional risks, the 2 channels that will somehow translate themselves into more subcategories. And so physical risk is really the risk of directly affecting the exposure from the insurers from climate change. And the transition risk is the risk that are related to the transition towards a carbon neutral economy. Those two risks are further defined in subcategories. And so for physical risk, we have the acute risk, so something very intensive and short term. So you could think of the floods we had last summer. And the somehow chronic subcategory, which is more long-term. So you could think of health disease related to lung disease from pollution, loss in biodiversity, of also sea level rises, for example. So those are the two subcategories of physical risk. With respect to transition risk, there are 5 subcategories identified by EIOPA. The first one being policy risk, so the change in regulation, carbon pricing, technology risk, and the uncertainty that is related to the new technologies and the existing technologies. So we had the concept also of stranded assets bubbles. Market sentiment risk, which is more related to customer behavior. And we had a very interesting presentation on reputational risk and the link to litigation risk. So those are the 5 sub-risks of the transition risk. Of course, there is a continuous evolution, and this is why we are all there today to contribute at our level to some kind of knowledge sharing, to have an impact at our level. In terms of we need to develop data, methodologies, approaches, but be reassured there are already some very good references, and you can find them in EIOPA consultation paper on the guidance on climate change in ORSA. So you have the NGFS scenario, so the network for greening the financial sector, and those scenarios combine representative concentration paths in terms of greenhouse gas emissions with socioeconomic pathways. You also have the IEA pathways, so the International Energy Agency pathways, where they somehow have a view over 5 years of the companies, how they are going to produce energy and with which technologies, and to assess whether they are aligned or not with the Paris Agreement. And also stress tests. So you should know that EIOPA recently issued a third document on best practices in terms of methodologies for stress testing. We also have some local supervisors who took initiatives in the UK, for example, the Netherlands or France. And we also know that the current IOP stress tests include a component on climate change. On the next slide, you see that, well, the materiality assessment can be done really by combining qualitative and quantitative analysis. And the qualitative assessment could be based on drivers of climate change, as EIOPA has presented them, whereas the quantitative assessment can be based on exposures and can also be qualitative and quantitative. When something is deemed not to be material, it has to be explained. And there is a 4-step approach so that you have a heat map in the short term, medium term, and long term, combining 2 axes. So the axis we usually know being the impact and the likelihood. And in the 4-step scheme there, you see that first of all, you have to define what is your strategy, your business context, the regulation. And also somehow in the second step, think of what could be the impact of climate change for you. Then really assessing how relevant it is by making more concrete to your exposure. And then if those risks are assessed to be material, you should go to the next phase, which is performing a long-term scenario on the material exposures. So I think now Frank will take the floor to explain you more the scenarios in details.
Yes, exactly. So as Daphne already mentioned, we need to at least explore 2 long-term scenarios, one below 2 degrees centigrade and one above the 2 degrees centigrade, just to really see how resilient undertakings are under all these uncertainties. This is quite relevant just to see like several effects that can really be relevant for the companies. And secondly, it's also quite clear that, especially when you think of these long-term scenarios, you cannot be as precise as you used to run these scenarios in the ORSA till now. So 5-year scenarios are based on planning, but obviously 80 years you cannot have in the same quality. So therefore, especially for long-term, it is accepted that you have lower precision, which actually is something which is quite difficult for us actuaries. I know that for myself. So how can we really cope with this lower precision, but still be able to produce such scenarios? However, they are expected to evolve over time. Actually, it's quite natural as we get more and more information over time, more and more results coming from research and also from our own experiences, how climate change will develop and like affect us in the future. So this is also expected from EIOPA to be included. Then it's very important to have adequate reporting, that it's clear for the readers, especially for the regulators, what are the material exposures, what kind of methods and assumptions have been used, and then also the quantitative, qualitative outcomes of our analysis. It starts with the materiality assessments Daphne already mentioned, but then also it ends with the results and the effects on our business and our, well, perhaps management decisions we might take to mitigate these risks in the future. That also needs to be considered and also to be reported in the ORSA that the local regulator, but also EIOPA, has the possibility to get an overview of what's happening in Europe and what kind of risks are the industry really coping with, and what are the main effects of climate change, what is expected, and how can also EIOPA and the local regulators support the transition. For the application guidance, and that's what the current consultation is all about, it's really trying to help, especially small and mid-sized undertakings, to really cope with these quite demanding and new requirements. And as I said before, especially for us actuaries, I'm a bit joking, but especially for us actuaries, it's hard to be less precise, well, especially doing these scenarios for the next 80 years, with a lot of question marks and uncertainties. That's hard to tackle. And that's the reason, and we do very much support and also like the idea of EIOPA to support small and mid-sized undertakings in this endeavor, in this way, on this way forward to assess these risks and give some ideas and concepts and also examples to really well, approach this new way forward of having these long-term scenarios. What we think, and that might be the answer, we're still aggregating and finalizing our answer. We still see some improvements to be done and way forward. How especially like the right time horizons could be used, how management actions could be included, how scenarios and the effect on the economic balance sheet could be included in these assessments, and then also how to assess materiality at the very beginning, which is the starting point for all these discussions. So we have experience, especially for small and mid-sized companies, that especially those 4 topics, companies and actuaries are really struggling still, even with the examples as provided from EIOPA. And actually, that's also the starting point perhaps for our discussion, as it's perhaps in the long run, not just for us in insurance, in ORSA, but also when it comes to the stress tests for insurance, but then also for pensions. There might be also these expectations on how to perform stress tests, how to interpret them, what can we do jointly together with insurance and pensions to really, well, provide and increase transparency on all these effects of climate change, and how could we really do that jointly and explore these potential effects and dangers we need to mitigate and manage. So I think that's perhaps a good starting point for the discussion.
Yes, thank you very much, Frank and Daphne, for a very interesting presentation. Maybe if you could leave up those slides whilst, or we can put that particular last slide back up shortly. What I would suggest we do, I noticed there have been one or two questions raised in the chat, but before we do that, I'd just like to ask Tatiana and Gabor and Gregorio if they've got any responses to some of those questions that Frank highlighted. So Tatiana, Gabor and Gregorio are all members of the AAE Pensions Committee, and therefore particularly interested in things like the aura rather than ORSA, etc. Do you have any immediate thoughts or comments on how we can leverage the insights that are emerging from the insurance space to help with similar challenges in the pension space? Or do you believe that unlike the reputation insurers have in this, according to the Jerome's fascinating slide, that pensions are basically would score 9.5 out of 10 anyway, and therefore don't need to worry about this particular issue? So any views from you or Tatiana or Gabor, and then I'll ask Gregorio as well if he's got any views. Apologies everyone for the technical difficulties. So maybe we should just then try and answer the couple of questions that have been highlighted in the chat. So I think Michael has got a question about whether we think EIOPA will have planning assumptions for the long term and will also develop scenarios on future business volumes. Is this something that we're well positioned to answer, as we don't represent EIOPA, but your views on?
I have no information about any of these plans yet, so unfortunately I cannot answer the question.
No, I would just add that we'll have to follow up what is discussed during those workshops and maybe give an update by June.
Okay. And it's always struck me that it's a very important element. If you, for example, if you have this one-year business model that we were talking about as maybe has some issues, essentially, if you believe climate change is more than 1 year out, it's not going to affect your current position, but it clearly is going to affect your long-term business sustainability. So how do we draw those things together? So Mike, a very good question. I'm not sure we have the answers yet. And Gabor has asked whether we could take or the regulator could take a lead in doing scenario tests through, or some of this analysis through scenario tests rather than just expecting the insurers to do things through the ORSA. Do you have any views on that, Frank or Daphne?
I think it's important, as the O stands for own risk assessment, that actually perhaps you need really both. You need like a general view, how is the industry at all affected for on certain scenarios. That's the reason for the stress testing. But then on the other hand, each company for itself needs to analyze what are the main risks for itself and how to react and mitigate these risks. And therefore, it is very relevant that these companies are empowered and also can facilitate an own risk assessment, both insurance and pensions. And therefore, it's getting a bit more complicated than just setting standard scenarios to be used. It needs to be translated. And therefore, we have this rather complex process of checking materiality and then analyzing and deploying these scenarios, and then really these own scenarios, relevant scenarios for each company. That rather complex process has to be done. Otherwise, it wouldn't really be helpful for management to base their decisions on these assessments.
Okay, Gabor's
Okay.
commented again about, and there's a bit more chat coming through between Gabor and Samuel. So maybe I'll leave that to emerge in the chat, but let's see if...
Can you hear me now?
Yes, we can. So maybe we can go back to those earlier questions that Frank highlighted and ask for your views as to what lessons we can transfer over to the pensions area.
Okay. First of all, apologies, and for all the audience, all members of the audience, is just before the call, we just had a test, and it worked properly for everybody. So I really don't know what happened. Yeah. So just some thoughts about it. First, I fully agree that what Frank and Daphne explained, it is they are all or almost all very relevant issues for the pension. It's very similar. I would just like to highlight some obvious differences. Is that, of course, in the pension side, we do not have this non-life insurability issue because pension is pension, and on the other hand, pension had. So it's simpler, but on the other hand, it can be regarded more complex because, first of all, the IOPS, so the participants of the market, behave, I would say, very similarly to the insurance companies, so the same effect. But there is a big difference, is that an insurance company can either deliver on promises or fail to deliver on promises. So it's a yes or no, it's binary, I would say. For the pension funds, for the IOPS, there are additional options because they have an option to ask for more contribution from the sponsors, and they can also agree with the members to reduce the benefits. So that's why it's not a yes, no. So it's much more difficult to measure these things in case of the pension fund market participants. And another difference we should say is that in the pension industry, we also have this macro approach if we look at the social security systems. So one is that this macro approach comes through the working on the operation of the market itself, but and it's the same as the insurance companies, but without that effect, the social security systems are also impacted, and that will be a nice link to the intergenerational fairness as well. So only that.
Thank you. Maybe Tatiana, do you have any additional perspectives you want to raise?
Yes, I would like to thank first for Frank and Daphne for brilliant presentation of the issues which are in front of our industries. Of course, there are a lot of similarity in the problems between insurance and pension industry. As far as we know till now, based on our recent discussion with working groups on behalf of IOPA, in case of ORA and the coming stress test for pension companies, only assets will be impacted by the current climate risk scenario. So we are aware as actuaries that it is not less important to assess how to value impact on the liability side, but it is more challenging issue in front of us as actuaries. If I can compare with non-life business, we are somehow in position to predict in the better way how to stress liability side when we are talking about catastrophic risk on some other climate scenarios. But if we talk about life insurance or pension business, it is more challenging. First, we need to assess how expected climate changes will impact longevity, health, of the population, how it will looks like with regard to dynamic of demography and population, and at the end we will be in position to propose at least kind of scenario for liability side. But without having such scenario, our exercise will be only partially executed, having asset side stressed only. So there is still room for improvement and a lot of challenges in front of us as actuaries. I'm not sure that we are aware about all implications and difficulties ahead of us, but it is still motivated.
Yes, thank you. Thank you for those comments. I noticed in the chat there's further discussion between Gabor and Samuel about scenarios, and I think part of what we're highlighting is the challenge of an own risk or ORSA or aura versus a sort of regulator defined way of looking at risks, and of course we all want to be heading in the same direction, so maybe that dichotomy is necessarily has to be there, but maybe we don't want it to be too strong. But just picking up on some of your comments, Tatiana, about the need to think about the liability side and broader than just assets, I think that does neatly bring us to a broader perspective on sustainability. It's not just about climate change. And I think, Gregorio, you've got, maybe we can now ask you to give your presentation, which is looking at a kind of broader perspective, which I think will add additional dynamic to our debate.
Thank you very much, Malcolm. Do you hear me?
We do, thank you.
Okay, perfect. So thank you very much. The idea that we have now is to share with you how we see that social sustainability could connect with intergenerational fairness. Okay, this is something that we are going to base this presentation, no more than 10 minutes, using an exercise that our Australian colleagues perform, okay, in which they will share, how they are handling with that. Okay, this is a very good exercise that why not? This could affect to European countries, and please think about how this could connect in your own country. Okay, so let me begin stating or mentioning one of the statements that the vision of the AAE has, okay, because the vision is for actuaries to be recognized as the leading quantitative professional advisors in social protection. This is one of the angles, okay? At the same time, contributing to the well-being of society. And this is something that we are going to discuss about that, okay? Additionally, we share values such as concern for the public interest and independence and integrity. So, and we are talking about that. As profession, we strive to understand and measure, specifically measure and manage the risk that we are facing globally and within Europe, okay? And social sustainability is one of them. What we are going to share with you is how our Australian colleagues perform this intergenerational equity index, in which they are tracking and assessing 24 indicators across 6 broad domains related to wealth and well-being for the three age groups. So we are going to talk about society divided in 3 age groups, 6 domains, very broad, talking about health and well-being, and within these domains, 24 indicators. this could be, and this is in the case of Australia, a good basement of potential public policy solutions based on a intergenerational fairness approach. Okay, we are not going to discuss or to talk about all the details about this index. We are going to share with you a snapshot about that. Okay, what does intergenerational equity mean? This is a concept of fairness or justice between generations, often covering economic, psychological, and sociological aspects. Okay, but a discussion from our point of view of intergenerational equity should consider a broad range of wealth and well-being dimensions that differs across generations. So people care about, of course, about income and consumption of goods and services, but at the same time care about factors such as health, housing, and the environment, as these are also important to broader well-being. With the purpose of this intergenerational index is to assess inequality between generations and inequality within generations themselves. Okay, and although the importance of intergenerational equity is well known, there is no metric set or rules to be followed. So this is a first exercise, as far as we know, unique on a global basis, that we are thinking to replicate in Europe. How this is constructed, as this presentation is going to share with you afterwards, we are not going to go to these specific details about the construction, because there is something about absolute and relative changes between year by year and among generations. It's based in publicly available data and so on. So we think that the main goal of this presentation is to share with you the concept. Okay, what is behind these 6 domains? Please remember these: economic, social, environmental, education, health, and housing indicators. These are the domains, but under that we have or they have selected 24 indicators, like, for example, average wages, poverty rates, net worth, government net debt, rate of incarceration, gender pay gap, atmospheric CO2 concentration, home ownership rate, rental cost, life expectancy, year 12 completion rate, as examples. Okay, based on that, and please see these 4 graphs, okay, in which we are sharing, in this case, the output of this exercise in Australia. Ideally, each of the European countries could have one of them. Specifically, for example, in Spain, my country, we are just in the middle of a pension reform. So this information could provide objective guidelines to the politicians, okay, in order to see which is the current situation of this wealth and well-being per each of the 3 age groups, and how this has evolved. Okay, and you will see that in this case we have 4 different graphs. Okay, up left is absolute index value. The highest is the index, the highest is the wealth and well-being perception. Okay, for these 3 different age groups, okay, you will see that the group, the oldest collective, in this case at 2018, the date for this exercise, this has been evolved, and we have new information about 2019 and 2020, how this has evolved. Okay, the best considered collective under this exercise was the oldest one, then the middle ages, and at the end the youngest people. let's see later how this fits with sustainability. Okay, up right, we have the relative change between age bands. Okay, in this case, you will see how this evolves, comparing each two age bands among themselves, and how this has evolved. Okay, and down left, you will see which is a comparison two different age bands, in this case the youngest with the oldest, how the contribution of each of these domains has in the total value, okay, of this difference. In this case, you will see that for those health, education, and social domains that are which is the contribution, okay, around that, and how this differ from, in this case, environment, economic, and housing, so which has a lower value in comparison with the 0 level, okay. And down right, you will see which is the difference since 2000 until 2018, which is the level of this exercise. So you will see that environment has been the domain that has performed worse in this comparison between these two age groups. Okay, so in summary, and this is the output for this exercise in Australia, is currently all people have a better index than younger people. So it's better performance in health, education, and social, but it's worse in economic, housing, and environment. So this index finds that wealth effects of housing boom and the increases in government payments on pensions and services for older people are the key reasons that younger Australians today have relatively lower wealth and well-being. So this is trying to put in context these indicators under these 6 domains, how compare per each of the age bands. Okay, so the inequity in this case, conclude the study, is supported by policies which are mainly focused on the needs of older Australians, whilst those working age groups are not efficiently attended. So this is not sustainable. So this is part of the connection between social sustainability, at some point financial sustainability as well, if we talk about pensions mainly, with the intergenerational fairness. So in this case, longevity problems as well as lower birth rates contribute to make the gap bigger. Okay, probably you are familiar and you are thinking in your own country and how this could affect. Do you have some similar flavor or not? This is something that we are committed to performing in Europe as well. The next step is provide under and following, in this case, the values that as profession we share, recommendations to public policy. Okay, so and these are the conclusions of from our Australian colleagues. In this case, they suggested review rate of unemployment benefits, maintain, for example, supply of social affordable housing in line with population growth regarding housing. In terms of health, increased spending on mental illness prevention and intervention. Continue to monitor international evidence of the effectiveness of sugar taxes. And for example, in environment, implement a carbon emission reduction strategy that meets global commitments and so on. So at the end of the day, is once you have measured, you could provide some recommendations. Okay, there are some technical considerations about that. Just a couple of comments about weighting and aggregation, because this is a difficult exercise, because this index uses 2 stages of weights. Firstly, within domains where all indicators weights the same. The one exception, the home ownership rate, that was considered to have a particular importance. And second, the final index is the weighted average of these 6 domains, as you could see. Okay. For example, the last point, the index is sensitivity, to give a guide as to how measures contribute to the index. Our colleagues calculated the change required in the indicator to produce a 1-point improvement to the index. So at the end of the day, there is a technique behind that. So, and finally, and this is what they conclude, so changes need to be made so that most people do not believe that they live in a place where their children will be worse off. So they conclude that such a system is not sustainable. Okay, so if you think that this topic is interesting and even more important, that you would like to contribute to face this, please join us to the working group under the pension committee umbrella that we are going to set up in order to design the European index. Okay, so please contact, in this case, with Monique. You will see the web mail address. So I hope this could help to the discussion. Malcolm.
Brilliant. Well, thank you very much, Goyo. That was fascinating. Can I encourage anybody involved in the public policy debate, maybe if you have joined from the Commission or from some other party that's involved in setting public policy, to think through some of those presentations, because I think it's really great if you measure something, then that can provide a more informed debate and transparency. Of course, once you get into public policy, then you start to run into the question of trade-offs, and so some of the subtleties like the index construction in themselves indicate what trade-offs we think are most important. So, but at least it's more transparent when it's presented in this kind of way. So thank you very much. Again, just in a bit of housekeeping, we're going to make the slides available shortly after the webinar to participants. I think the plan also is that they'll be made available through the AAE website. So hopefully that will, when they come through again, that will reinforce the message. And again, as Goyo has highlighted, if you want to be involved in this topic, or indeed any other topics that we've been covering so far this morning, then please do contact the AAE, and we'd love to have more volunteers working on all of these activities. I've got a question in the chat from Jerome, who asks, to what extent is the index that you're envisaging here going in the same kind of direction as the UN's Human Development Index? Is that something that's motivated thinking in this space? Goyo, do you have an answer to that?
Malcolm, if I may add some comments, I'm not sure whether the index prepared by Australian colleagues are quite well harmonized with idea behind United Nations index, but looks quite complex, and probably it is interesting to see how this approach would work, and what the graphs could be for a couple of different European countries. As I saw from a presentation made by Gregorio, the main, probably the heavier domains are social and economical segments, because there have been put more indexes. although additionally some extra correlation based on factors weights have been presented, but seems that based on these two major categories, we could expect quite different results from country to country. And I would like to thanks very much to efforts put by Gregorio for preparing this quite a good summary and presented us the essential outputs from work done by Australian colleagues. So we are very keen to form kind of working group from volunteers and to try to develop something similar for our European countries. But let's see how much energy we will collect on this topic. Thanks once again, Gregorio.
And Gregorio, did you have any other comments on that question about the UN Human Development Index?
Maybe I think that as I began to explain, I don't see very complex calculations behind that, okay? But I don't see any other profession very well equipped to perform this, because if you saw our values as concern for public interest, integrity, independence, collaboration and respect in this case, and transparency and accountability, I think that we have a word to say about that and provide some transparency about what is happening in the society, because probably this is not very easy to understand. But with these figures, measuring risk and sharing with the society in a good way, leveraging from a easy to understand communication approach, I think that we could make a good contribution.
Yes, thank you. Can I just ask the individuals who've got more of an insurance bias, so that'd be Frank and Daphne, perhaps. Clearly in insurance, there's quite a lot of focus, at least for some sorts of products, about fairness and financial stability. And I think thinking here of mutual companies or companies where there's participation in profits and there's a need to kind of share those profits in fair ways between different policyholder groups and cohorts. Are there any lessons that you think the insurance industry maybe has learnt through bitter experience or accidental happenstance that might help and inform how we might be doing this at a pensions level or at a broader society level? Any thoughts?
I'm having some thoughts. I think that mutualization is really important, and you really need to find a balance between mutualization and fairness. Those are important concepts. And I think do not forget the role of regulation on those concepts. I think indeed in the insurance sector you have the profit sharing allocation and how long you have already been there while benefiting from a high guaranteed rate, whereas the most recent generation has somehow been victim of the lower rates. Now we are in an environment of higher inflation, so what's going to be the impact on this fairness and mutualization? So I think it's more on the life side. And also, I think what is really important is inclusion, that we see some policyholders are more difficult to insure be it from a health issue or a non-life exposure issue. And most of the time, those are also the ones that are the less privileged. So I think it's an attention point there. But the regulation can really play a role to either foster this fairness or to somehow reduce this mutualization. And I think that for IFRS 17, it was the case. So we really have to be cautious about the unintended consequences of some regulations.
Okay.
Malcolm, may I just add something to this?
Yeah.
Is that, okay, my feeling is that imagine that we have such difficulties that there's an insurance portfolio and you have all the data in your database, how much certain clients paid, how about they got, what was their expected payments, etc. And we're still struggling to measure exactly whether or not it was fair. Imagine that in what happens in a society level. Society level, you don't have all the data, you don't have well-defined client groups, you don't know all the cash transfers. You also have to measure, for example, the unpaid work, which was much higher ratio for the women in 20 years ago, and will be much less. All these measurements are much, much more difficult and much more challenging. So very different methods we need. Still, the problem is the same, but yeah, just my comment. So it's very nice.
It sounds like, Gregorio, you have an interesting challenge ahead of you. And I think transparency, fairness, mutualization, and mutuality, these all are very sound concepts to aspire to. They're not necessarily all easy to aspire to simultaneously. So we wish you well. Again, if anybody wants to volunteer to join you in that effort, then and Sam has raised a hand, so maybe I should ask him. Sam, did you have any particular comment, or as you just said, sign me up if you do have a comment?
No, it was with respect to fairness. I think within the low interest working group, we're looking into actuarial fairness and the various notions of that in the light of low interest rates and potential need for write-downs of insurance or pension benefits. And just to say that I think there are various notions of fairness, one being that as expressed by the contract or by the insurance company beforehand, the ethos of the contract, and then assessing it as the product lives, as time goes by, using the expectations of fairness to assess the performance of the product at an individual and a group level, and then also to look at fairness from the legal basis in each country, and also at a more philosophical level to look at any such contracts notion of fairness and say, is this fair? Perhaps objectively is not possible. But I just wanted to mention that we are looking into it, and it sounds like we could work together.
Sounds good, and thank you very much for focusing on that in your group. We've reached 11 o'clock, sorry, 12 o'clock even, depends on which time zone you're in. So I think we should close now. Can I again thank all the presenters for excellent presentations, for all the panelists, for all the input that everybody's provided, for everyone who's provided comments or questions through the chat. As I said, we'll aim to make the slides available shortly after the webinar, and also through the AAE website. And again, could I encourage you to volunteer for these excellent projects and activities that we're all working on. So have a great day, and speak to you soon. Bye then.